Where you're at.
Okay, so chapter 12.
Yeah.
Chapter 12, we're moving into stock. So we found, we learned in chapter 11 about bonds. So we know we could sell bonds to kind of infuse cash into the business without changing the ownership of the company. So now in chapter 12, we're going to talk about stocks as well as dividends. So we're looking at like equity accounts really. So selling stock does change the ownership structure of a company. So we're going to look at how to account for when we sell or purchase stock, as well as we've done, common stock before in college accounting procedures, when like the owner invested money, it was just a debit to cash and a credit to like common stock. Well, now we're just going to go a little bit further into it, and same with dividends. Like usually what happens with dividends is they declare a dividend up front, and that creates a liability where we have to pay the dividend at a later date. And so we're just going to look at how we account for that. So just a little bit different, okay? So we know, of course, this is a review. Corporation is a legal entity. It's separate from its owners. It exists all on its own. So a corporation can acquire and sell, like stock and other goods and property. So again, the big part in this chapter is we're going to deal with stock. So of course, the reason that a company goes public and wants to sell stock is to infuse capital or money into the business. So that's kind of the whole purpose here. Again, with stocks, we are changing the ownership of the company, whereas bonds, when we sell bonds, we have to pay that money back, but we're not changing the ownership. So with bonds, we're paying regular interest payments, but we're not changing ownership. Whereas with stocks, we're selling shares of our stock, so we're selling ownership of the company to the stockholders. So it is just a little bit different, but it is a good way to get large amounts of capital or cash into the business. Stockholders, they own shares of the corporation, and they can buy and sell stock without affecting the corporation's operations or existence or anything like that, okay? Of course, we're going to deal with public corporations that are traded on like the New York Stock Exchange or NASDAQ, that sort of thing. We're not really dealing with private corporations. Private corporations still have shares of ownership. It's usually within the company, like the owner of the company usually holds majority share in a private corporation, and then they may offer ownership to like their employees. Private corporations generally are owned by employees. That's usually where the stock goes in. But it could be another, some outside investors too. But for the most part, that's different. So we're not going to focus on the private corporations. We are looking at public. Again, when we're dealing with stockholders, yes, stockholders own a portion of the corporation, but they have limited liability. So, this is where we talked about this in college accounting. Basically, you're only liable for the money you've bought of stock. So if I bought 10 shares of stock and the company went bankrupt, I might be out those 10 shares, the money I purchased those 10 shares of stock. Of course, where it can get detrimental to stockholders is if we've been a stockholder for several years and that money has grown, the stock has increased over time, you could still lose a large amount of money. But again, you're never out more than what you invested originally. Okay. Basically, how a corporation is broken down, and again, I think we learned this way back in chapter 1, going all the way back, right? The stockholders don't really necessarily, they don't have control over everyday functions of the company. Stockholders are the ones that basically they vote on a board of directors. So all stockholders have the ability to vote in board of director members, and that board is the one who oversees and runs, per se, the company. So really the board establishes policies, and they can hire and fire like the CEO and things like that. But the CEO, the CFO, those vice presidents, all the people kind of top level usually are on the board of directors, but they're the ones doing the everyday running of the company. So as a stockholder in a company, you can't like call up and be like, you know, you need to like build a Walmart by my house. You know, we have no control over everyday operations, but they can vote in the board of directors, which can oversee corporate policies and make changes. Okay. So basically the stockholders are at the top of the chain there, but again, their rights are really voting for a board of directors who then oversees, like establishes corporate policies and oversees the CEO, CFO, those people, and then everyone else is underneath that level. Okay. So again, with a corporation, it is its own legal entity. So a corporation does pay taxes. Okay. Stockholders, the only tax that they're liable for is any income tax on their dividends. Okay. So if the corporation pays out dividends, which is an if, they're not required to, then the stockholders would pay income tax because those dividends would be considered investment income, basically. Okay. It's just talking about the advantages and disadvantages. Again, we've kind of been through these before. So the big ones, advantages, it's separate legally from its owners. So that's that limited liability goes with that too. Continuous life. So even if the CEO passes away or the owner passes away, you know, it's going to continue on. They're just going to replace that person and that business is going to continue. They're able to raise large amounts of capital through the sale of stock. And ownership rights are easily transferable. So stockholders can basically sign their stock over to other people. Okay. Disadvantages, owner is separate from management. Again, you know, the stockholders really don't have a lot of say. So sometimes management or the board of directors might not act in the best interest of the stockholders. They're looking for the corporation. Their number one goal is not the stockholders. It's the corporation. Okay. Double taxation of dividends. So basically that doesn't affect the corporation as much, but it affects the people that own stock. So dividends are taxed at the corporate level, and then the individuals that own dividends are also taxed. Okay. And then just regulations, you know, they have to follow a lot more public, you know, GAAP, basically generally accepted accounting principles. They have to have an outside auditor. They have to have internal controls. A lot of those regulations, and there's more beyond that, environmental regulations and such, that publicly traded corporations are going to be held to more than private ones. We're not going to go through all the forming a corporation. Not really that important. I think the only thing is when you're journalizing from an accounting standpoint, when you do form a corporation, there's incorporation fees, legal fees, taxes, all of that stuff. The journal entry would just be a debit to organizational expenses and a credit to cash, or however we're paying. Okay, cash/checking. So that's really the only thing you need to know as far as forming a corporation, is that all those incorporation fees and taxes just get debited to organizational expenses. So let's get into actual stock here. So two main sources of equity, you know, when we learned about stockholders' equity, are paid-in capital or contributed capital and retained earnings. Okay, paid-in capital comes from issuing stock. You know, we saw on our balance sheet in college accounting procedures, that was all we really had under stockholders' equity, right? You had common stock and then retained earnings. Okay, we're going to have a little bit more on that, but it's all going to be stock related. Okay. So when we start talking about stock gets issued, and then basically a corporation is going to issue a number of shares. Again, that doesn't mean that all of them get purchased right away, but we're going to issue, you know, a large amount. Okay. They establish that, basically the board of directors establish that when they establish the corporation's charter, and it tells us how many shares of stock they're authorized to issue. Again, that could change over time. You know, the board of directors could decide to increase that and sell more shares at a later date. Okay. So what they're authorized to issue is just stated in their charter. And then the term issued just refers to the shares that are actually issued to the stockholders. Pretty easy, right? And then we're going to talk about this a little later, but a corporation can purchase their own stock as well. Okay, that's called treasury stock, and we'll deal with that here in a little bit. The stock remaining in the hands of stockholders is called outstanding stock. Okay, so we have the total authorized, and it's either issued or outstanding. So we talked about par value when we dealt with bonds, like the par value is just the face value of a bond. We talk about par value with stock as well. Par value is just the dollar amount assigned to the stock. It really has no real meaning. It's great, right? It's just the dollar value assigned to the stock. That doesn't mean it's how much it's actually valued at. They just assign a par value, okay? Most of the time. So most stock you will see assigned with a par value. Sometimes we have just a no par stock. So there is an option where a company can actually just sell stock without any par value. It really just changes how we account for it a little bit, but it doesn't change the value. Again, these are all kind of arbitrary words when we're dealing with stock, and it depends on the state whether they're authorized to do that. Some states require some stated value. Okay, so we could have a stated value or a par value. It all really means the same, in that it doesn't mean a whole lot. That's good news, right? Except for how we account for it. Okay. To protect creditors, some states require that we hold on to a certain amount of our paid-in capital. You know, that way, if we were to have legal issues or creditor issues, then we would have that money in reserve to pay that. Again, those go to state laws. Again, as far as like the rights of ownership of shares of stock, again, they have the right to vote on the board of directors. They get a right to share in distribution of earnings. Again, that's through dividends. And then also through increase in stock price. And they get the right to share in assets upon liquidation. So if a company were to decide to dissolve or go bankrupt or whatnot, obviously when that happens, they would take all of the money they have, pay off all their existing debt. Whatever money was left over would be distributed to the stockholders based on their percentage of ownership. So again, it depends on why the company goes under. If they just decide to quit doing business, they may have money to share. If they go bankrupt, there may not be much left over after the debts of the business are paid. And unfortunately, you know, stock prices, you would already have seen a decline in your stock value at that point though too. There's two main types of stock that we're going to deal with. Well, really three, I guess, when you talk about treasury stock too. So we have common stock. Common stock is just the main class of stock that a corporation offers. And you could have preferred stock. Preferred stock gives the owner of preferred stock a right to dividends first. So all that means is if a company were to declare dividends, those with preferred stock get paid dividends first. So they have a higher right to those dividends. Okay. And we'll talk about that a little bit more. And it could be either a dollar amount per share or as a percent of par. Okay. So it just depends on how it's established. So common stock still has a right to dividends, but preferred stock gets, you know, preferential treatment to those dividends first. So if the company only declares a limited amount of dividends, it could all go to preferred, and common stockholders may not get any. Not all companies offer preferred stock though, and that's one thing when you're doing your group project you'll be looking at, I believe, is if they offer any preferred stock. Don't be surprised if they don't. I don't think it's not a super common thing, but it is an incentive. So, you know, they're buying that stock, they may pay a little bit more for it, but they have a higher right to dividends if dividends are declared. That's always the the big deciding factor if the company actually declares dividends. Okay. So again, that's what I was just saying. Basically, preferred stockholders have first rights to any dividends, so they have a greater chance of receiving dividends. However, dividends are based on earnings. And even if a company is highly profitable, that doesn't necessarily mean that they'll pay a dividend. Dividends are paid out when we have cash to pay them. We had a profitable year. But there may be other reasons why we don't pay out dividends. Like maybe we're looking to expand operations. So we're going to take that money, that retained earnings, that profit that we've made, and put it into a new product line or a new factory or something like that. So even a profitable company may not pay dividends. It just depends.
So what's the point of investing in stocks if you don't?
Well, the goal would hopefully be that the company is going to grow and their stock price will increase. So you're earning that money on the stock that you purchase. So you may, hopefully, like if you had purchased stock in I don't know, Amazon 20 years ago or whatever, I don't even know how long they've been around. They've been around a while though, right? So, you might have purchased it at like $20 a share or something really low. If you get on the ground floor, well now, Amazon stock is worth a lot more than that. So you're actually earning money on that, and then it's capitalizing interest because, over time. So people will invest in stocks in the stock market to hopefully grow their initial investment. And then, a lot of companies will pay out dividends. It just may not. Most people don't rely on the dividend payout, though, as much as just the growth of the stock itself. That's usually why people invest. But there are companies that do pay out dividends. It just, I wouldn't rely on that as a source of income unless they, say they, unless you can historically show that they pay dividends every year, basically. So it just depends on the company. What's going into dividends? I'm not ready to go into dividends. We'll go back to dividends. Where's just the common stock? I feel like this is out of order. Sorry. I'm like, what's going on? You gotta love it when the PowerPoint is in a weird order, right? It's dividends, stock dividends. Okay, let's talk about issuing a stock, and then we'll go back to the preferred stock and the dividends here in a minute. It's a little out of order. So basically, when stock is issued, and that means it's been purchased by stockholders, then we're receiving cash and we're crediting our stock accounts. Okay. If they're issued just at their par value, it's a really easy transaction, kind of like bonds. We're just debiting cash for the full amount of cash received, and we're crediting the correct stock account based on its par value. In this case, we have both preferred and common stock, which, as you can see, when we're journalizing, though, it really doesn't matter if it's preferred or common. As long as it's par value, it's just the same. So it says, assume that a corporation is authorized to issue 10,000 shares of $100 preferred stock and 100,000 shares of $20 par common stock. Okay, that's what they're authorized to issue. That doesn't mean that's what's been purchased. So the corporation issued 5,000 shares of preferred stock and 50,000 shares of common stock at par, for cash. So when they say what was actually issued, that's how much stock we actually sold. So we sold 5,000 shares of preferred stock. Well, it's 5,000 shares times $100 value. So that's where they're getting the 500,000 preferred stock. And then for the common stock, it's 50,000 shares of $20 par. So when it's issued at par value, we just take however many shares were issued times the par value. And that's where they're getting the $1 million. So all total, we sold preferred and common stock for a total of 1.5 million, 500,000 credit to preferred stock, and 1 million credit to common stock. So issuing stock is pretty simple. Again, the par value is really just what's assigned when we issue stock, so it's kind of an arbitrary amount. It's often going to be issued for a price greater than par, so it just depends on the financial standing of the corporation, what they think its potential earnings might be, and then just general economic conditions in the market. So, you know, when the stock market is down, obviously, even when we're issuing new stock, that's going to be issued at a lower price than when the stock market is up. So again, this is all based on supply and demand, good old economic principles that we will not go into in this class. Right? We will not do supply and demand curves, yay! But, you know, it's still important to understand that the market is influencing stock prices, obviously. So sometimes stocks can, the stock value can be inflated, right? Because investors may overvalue the company, and that happens sometimes, and then we see that it doesn't sell and it tanks. So we're going to assume in here that the company is healthy and it's selling at, you know, this, we're going to make the assumption that all things are great, which we know at the market things aren't always great. We're going back into those terms, premium and discount. So basically it means the same thing as a bond. When we sell stock for more than its par value, it's considered selling stock at a premium. If we sell it for less than par, then it's going to be a discount. Okay. So the difference of what we're going to sell it for, when we sell stock at a premium, any money that we got beyond the par value is going to be credited into this paid-in capital in excess of par. It's a long word, right? And it can be common stock, preferred stock, it doesn't matter. Paid-in capital in excess of par value. That's all it means. Again, that par value doesn't mean that's the true value of the stock, so we could sell it at any amount. So assume that Caldwell Company issues 2,000 shares of $50 par preferred stock for cash at $55. So $50 is the par value. We're always going to record in the actual stock account the par amount. So 2,000 shares at $50. That's where they're getting that 100,000. Okay. So we always record into the common stock or preferred stock the actual par amount. Anything over par gets put into paid-in capital in excess of par. So the difference is $5, right? We sold it for 55 instead of 50. So we had $5 over par, 2,000 shares at a $5 premium. That's where they're getting that 10,000 in paid-in capital in excess of par. So we just take the difference, the increase from the par to the actual issued value. Okay, and that's where they get the 10,000. We can issue stock in exchange for assets other than cash. So someone could say, hey, I've got this equipment or this building or this land, and that's fine as well. Okay. This says, assume that a corporation acquired land with a fair market value that cannot be determined. Well, that's always fun, right? In exchange, the corporation issued 10,000 shares of its $10 par common stock. The stock has a market price right now of $12 per share. Okay. So they basically valued this land at $120,000. So we're going to debit our land account at $120 because we're not getting cash, we're getting land. And then we still handle the stock the same way. So we record the common stock at the par, 10,000 shares at $10 or 100,000. And then it was a $2 increase. It's sold at a premium by $2. So 10,000 times $2, paid-in capital 20,000. Okay. So you just always have to calculate the premium amount, 12 minus 10, and then multiply it by the shares issued. Okay. So really this is the same thing, only land is debited instead of cash. Let's see. A discount would be debiting that paid-in capital instead of crediting it. So your common stock would still be credited at the par value, and you would just debit paid-in capital. Yeah, cash would still be debited for however much cash you actually received. And then you would also debit your paid-in capital for the discount amount at that point instead of a premium. Okay. I talked about you can also have no par stock. Okay. With no par, it's just whatever they tell us the selling price was. We don't have to worry about a par value. So it all just goes into common stock. So a corporation issued 10,000 shares of no par common stock at $40 a share. Well, it's $40 a share at 10,000 shares. So cash is debited and common stock is credited. So when there's no par, you don't have to worry about any paid-in capital. We just take the value that we sold it at. And then if we issued another 1,000 shares at $36 a share, 1,000 times 36, cash is 36,000, common stock is 36,000. Okay. So if you have a no par or no stated value, then you just go off of whatever the issuing value is. If it had a stated value, then you'll have to do the paid-in capital in excess. Okay. So instead of a par value, if it said it had a stated value, it's handled just like if it had a par value. Okay, so stated value and par value really mean the same. So if we issued the 10,000 shares of no par common stock at $40 a share, and then the same additional 1,000 at $36, the no par common stock is assigned a stated value of $25. So we're basically treating that 25 as the par value. Okay. So again, we would take $25 times the 10,000 shares to get the common stock. And then anything in addition, which would be what, $15, because we sold it at $40, we'd have a $15 above the stated value to get that paid-in capital. The only thing that changes there is the same paid-in capital in excess of par value, it says in excess of stated value. So if there's any par or stated value, we have to credit paid-in capital. Okay. Any questions so far? Super fun, right? You guys are all super enthused, I know, right? Well, let's go to the practice and do the first one. We'll wake up a little bit, right? Maybe. So this first one, we're just practicing issuing stock. Okay, so on the chapter 12 practice, first one says, on January 22nd, Zentric Corporation issued for cash 180,000 shares of no par common stock at $4. Okay. On the 14th, they issued a par value 44,000 share of preferred 2% stock, $55 par for cash. A lot of words. And then on the 30th of August, they issued for cash 9,000 shares of preferred 2% stock, $55 par at $60. Well, let's break that down one at a time because there's a lot of words all together, right? So very first one, it says we issued for cash 180,000 shares of no par common stock at $4. So what would I debit and credit to issue no par common stock at $4? Good. Cash is debited.
Common stock.
Yep. Very good. Common stock gets credited. And for how much? How much common stock did we sell there?
$720,000.
Very good. 720,000. So again, we have a no par situation here. So we'll just take it at the $4 that we sold it at. So we issued 180,000 shares at $4. So if there's a no par value, we don't have to worry about paid-in capital. So it's a debit to cash and a credit to common stock of 720,000. Okay. So no par. If that had been par and the par was $4, it would be the same entry, okay? On February 14th, we issued at par value 44,000 shares a preferred 2% stock, $55 par value for cash. Okay, that 2% stock just has to deal with the dividends paid on that preferred stock. So when you're issuing stock, don't worry about that 2%, okay? That's just the dividend payout on the preferred stock. So we're still issuing 44,000 shares, and they just gave us a par value, right? They didn't tell us it was sold in excess of par. So it was sold at the 55. So how would I journalize that one? Very good. Cash gets debited and preferred stock gets credited. And how much did I sell?
$2,120,000.
Very good. 2,420,000. $2,420,000. So it was just the 44,000 shares at the $55 par value. Okay. And then the last one, it says on August 30th, issued for cash 9,000 shares at preferred 2% stock, $55 par at $60. Okay, so this is one where we sold it at a premium, right? Because we sold it for more than the par value. So how much cash did we receive?
540,000.
540,000, good. We received 540,000 because we issued 9,000 shares at $60 a share. Okay, so 9,000 times 60. And then what do I credit?
Preferred stock.
Good. And for how much?
495,000.
Very good, 495,000. So again, we record the preferred stock at the par amount. So $55 times 9,000. And then obviously you can calculate the difference, you know, $5 times 9,000, or you can just subtract, right, to get the premium. So paid in excess of par preferred stock, make sure you choose the preferred stock, 45,000. Okay, so the difference is just credited to paid in capital in excess of par. And that would be handled the same way if it were common stock and we'd sold it at a premium. It would just say common stock and paid in capital in excess of par on common stock. Okay, so the journalizing is handled the same way. Just don't let that 2% throw you off. That's just the dividend associated with that preferred stock. Okay. Any questions on that one? It's not too bad, right? Better than bonds. You don't have to calculate and amortize you don't have to do any amortizations. You guys are supposed to like cheer or something. Yay! Do we need to get up and like run around the room, or I feel like I needed to bring like coffee this morning.
I told you I'd get you some.
Yeah, I mean, I'm fine. It's y'all. Y'all look like the ones that need coffee. Bless you. I understand. It's one of those days, right? What I'm not looking forward to, though, is the time change. And then, like, what's that, like November 3rd, I think? And then it's going to be dark at 6 o'clock at night. We get an extra hour because we fall back. So we'll do it. I think it's November 3rd, technically. So, right? I had to look it up the other day. The 2nd, yeah. It'll be technically November 3rd at like midnight or whatever. So really the Saturday night, the 2nd, is when into Sunday morning. Yeah, we get to fall back, which I appreciate that extra hour. But then, yeah, it's like dark at 6 o'clock. It's fun.